you doing? Welcome to On the Tape. I'm Dan Nathan. I'm here with my co-host, Danny Moses. Our third co-host, Guy Adami, is usually with us, but he is on his way to Sicily. It's something about seeing a guy named Dom Tomasino. I don't know. We're going to talk about that later. But in his stead, we have two really great contributors to On the Tape since we started in early 2021. It is Porter Collins and Vincent Daniel of Seawolf Capital. They are Danny Moses' former partners at Front Point back in the day. You guys might recognize them, maybe not. The actors who played them in The Big Short were a little better looking, not nearly as smart, but you guys, thank you guys for being with us on the tape here in Huntington Beach.
Great to be here. Yeah.
And obviously, EY from SoFi, she does market call with Guy and me on Thursdays. She is Liz Young. She is the head strategist at SoFi. So thank you guys for being here. Thanks for having us. All right, let's get into it.
Do it.
People.
Yeah.
What a heck of a day. I mean, we've had some momentous days with our friends from Seawolf on with us on the tape. You guys were mentioning back in June, it was just after that CPI print from May. It was hot. Then there was a trial balloon floated in the press that the Fed was maybe going to do 75 hike at that mid-June meeting. And what happened? Danny, the stock market went down 10%, the S&P, in a straight line into that Fed meeting. Talk to me about what we saw today, because the S&P down 4.3%, the NASDAQ down 5.1%, worst day in the stock market since June of 2020. And think back where we were in June of 2020. It was like a big black hole.
Yeah, I think the focus on all these inflation prints, whether it's 0.1 higher or 0.2 higher, is nuts. That's how you're going to trade the market over the long term. Fundamentals are going to matter the most. And as that works its way into the market, I think we're just playing around between 3,600 and 4,200 on the S&P for now to try to find the direction. 75 basis points for the Fed is now cemented. Obviously, I think next week and a half, whenever.
Yeah, but your range that you just gave for the S&P 500, that's like one day like today.
Right.
You're through the bottom end of it, right? So like you think the data right now, we're kind of, it's in the market's hands. It's not really in that whole kind of data.
I just think if that's what you're using these inflation trends as a way to trade the market, you're going to have bigger problems.
Yes.
And I think fundamentals, take that information. What does it mean to each company that you might own? What does it mean to the certain sectors that are out there? And that's how I would kind of break it down that way. So.
All right, but here, Porter, Danny just said, what does it mean to different sectors, different instruments or whatever? But like we know what happens in market like these, correlations go to one. How do you guys think about it? You guys have been unusually bearish for economic reasons, but the way you think about markets, the way you guys think about investing at Seawolf, you're obviously been very bearish and sellers of most rallies. You have been long stuff, but talk a little bit about that dynamic and the range that Danny talked about, the data dependency.
Well, Danny doesn't like to be called a bear. Like he just likes to be called realistic.
A realist.
Yeah, realist.
Yeah.
I consider myself a realist as well. And if you look at what's happening, earnings are coming down, right? The last two quarters haven't been good in terms of S&P earnings. Corporate profit margins are an all-time high. They're coming down. And, I think if you will rewind the clock to the May CPI print in June, things are a lot more bearish because the Fed's going further than I would have ever thought they would. Yeah. And so, Goodluck was talking about it earlier today, and they're gonna go right against a wall. And all these things happen with lag effects. The hiking of rates, the inflation data, and it's all over the place. And the problem is the Fed's in a real bind because the inflation is very pervasive. You saw one of the medical costs up, highest ever, 25%. Electricity costs, all that's going to hit with a lag. And, I just don't see a lot of bullish catalysts out there. We're short, we're long energy stocks still. People take, come at us a little bit of oil's going to fall, whatever. We're short a lot of stocks though here. Yeah. There's a lot of high-priced stocks, a lot of stocks that are reverting to the mean in terms of you got this COVID reverting to the mean. Yeah. You've got just a lot of stuff going on, and we're pretty bearish on stuff.
So, Vinny, you guys were on the energy trade for reasons other than some of the geopolitical stuff. Yep. When crude oil took off, in February before Russia invaded Ukraine, you guys were already long all these things. So you had a fundamental view on energy.
We got long when Exxon was taken out of the Dow. That really started the process. We tend to be contrarian in nature.
Talk us about that psychology. So, you saw that, and then you were like...
Well, we're contrarian idiots, right? So, we see Exxon being taken out of the Dow and Salesforce.com was put in. And we practically went long Exxon, short Salesforce.com, generally speaking. Salesforce a little later on. And so it started as a trade, just as sort of, let's do this, contrarian, it's funny. And then we started doing the research behind it. And then we realized that, holy crap, there's been a 10-year underinvesting cycle in fossil fuel energy. Everyone thinks we're going to solar and wind in 10 years. We'll be lucky if we get there in 30 or 40 years, and I would question whether we should do so to begin with, but that's a different issue. And then we realized we were sitting on potential names that were trading at 1 to 2 times cash flow. And they were paying down debt, and they were about to shove cash down your throat.
Yeah.
Right? And we're like, this is like a value investment.
What was the example on the pod in June? You guys gave an example of what company that you own was going to pay more in dividends. What was that? It was an
probably
energy.
Peabody? It was probably Peabody.
Oh, yeah.
That was a shipping company.
Yeah.
That was-
Oh, that was
Zim.
Oh,
Yeah,
that was
Zim, but we
Yeah.
did sell that.
Yeah.
But nevertheless, and it's still to this day that these companies are going to produce those cash flows. Now, we have to worry about the next 3 months because we're clearly in some form of economic slowdown. There will be a drop in aggregate demand.
and you do have Biden dumping oil.
However, Biden just said today that he's about to buy oil at $80 a barrel. So you have the Saudis wanting...
Pretty good consistent energy policy we got here.
So you have Saudi wanting to defend 90, Biden wanting to defend 80, right, or buying at 80.
Yeah.
And if we stay between $80 and $90 as an equity investor in these energy names, give it to me.
Yeah.
It's perfect.
Well, I want to get to like the potential for demand destruction and what like a global slowdown really looks like for some of these commodities and some of these sectors. And I really want to also talk a little bit about the relative strength. We were talking last night that some of the energy stocks that you guys are long are showing relative to the commodity. But Liz, you tend to really focus on value a great deal, and you've liked energy like for a good part of this year. How do you think about it? Because, and I definitely want to get into that pairs trade, long Exxon, short Salesforce, because there's a lot of stuff there. We were talking about NVIDIA. There's a lot of high valuation stocks. Danny, you say this on the pod all the time. You like those shorts sometimes when they're down 50% better than you like them very near their highs. But talk to us a little bit about how you're thinking about it from a value bent and where you think there's opportunities right now in the stock market.
I want to talk about something else first.
Okay.
Nice. Nice.
Well done.
Well done.
Whatever you want to do, Liz.
I'm outnumbered on this panel.
Yeah.
They've been nice so far. You're like hiding your bearishness.
No.
Wait,
It's
Goldilocks.
cute. It's cute. It's like,
Yeah,
like we're gonna roll into it real slow. So a couple things. It's right now in the market, especially today. You look at the numbers today. It is so easy to be bearish. It's almost lazy to be bearish
Wait,
in
what?
a day like today.
We'll
In a day like
to
today.
that in a second.
Okay. It's
just called
harder.
you a wimp,
It's,
Vinny.
No, she did.
it's much harder to be bullish. So you talked about, I think it was you, Porter, that said it's hard to find those upside catalysts. At this point, I don't even think there needs to be a catalyst. Everything is pointing to it could get worse from here. The catalyst is that we remove something that's really bad, right? We all hoped for that today. We hoped that we'd get an inflation number that wasn't as bad as it ended up being. That would have been a removal of a worry, and that would have served as a catalyst. So we're in this weird range in valuations where I think we're probably stuck in it for a while. And the bearish case would look at it and say, okay, with CPI at these levels, with this level of, I guess, consternation in valuations, PEs deserve to be 20% below where they are, right? They don't necessarily have to get there.
All right. So I'm the first bear coming out of the
So,
gate.
I did
All right.
that on
okay.
Got
purpose.
your
I was
word.
like,
You
what's
got-
wrong
you
with
got
them?
us
I got
going.
you.
They're
Right.
lying.
So
Yeah.
it's so hard. It's so easy to buy stocks and forget about them if you're going to buy good stocks over time. This passive ETF market has just lent itself to just, set it and forget it. This is the first time in 13 years that you actually are underwriting both stocks and bonds, in my opinion. First time you've been forced to look at what you own from the bottom up. Shorting is the hardest, most painful. It's a skill set, but it takes a lot of patience, right? And the timing has to be right. And most people that are good short sellers will always be early, and that's a painful process. You get a position that doubles on you while you're waiting for it to work, and you get called out of a name. You can get taken out of a name. So I think what's really important here, and you've talked about this, Liz, is from an age group perspective. If you've traded this market through 3 or 4 iterations of cycles, back to either 1987, 1999, 2006, 7, 8, and you see what can happen from a behavioral finance perspective. Shorting is very difficult because it's a timing issue. And my whole thing with today's print is that I don't care if it was down 0.2% of the market, was up 100 points on the S&P. It wouldn't have changed my mindset for what I think is going to happen. And the one thing I'll say before I let the other bears come out of hibernation here, we are underappreciating how bad things are in Europe, right? Forget about geopolitical risks in China, all that. Europe as a buying country, buying our products, they're screwed. I mean, they're 10 times worse than we are from a stagflation slowdown. And they are raising rates into an economy that is clearly declining. They have bigger issues than we do. So I just think we got to pull our head out of the sand and look at the macro here also. And this, I think, I really try to stay level-headed and stuff. But, I mean, I was bearish before today. Today's action
I just made it worse.
Yeah, you made it
well,
worse.
Hold one real quick anecdote on the younger investor thing. I got a text from my analyst he's in his late 20s.
Resume?
Right before this.
Yeah.
And
LinkedIn?
He's watching this happen all day, and he said all the text said was, "This sell-off is crazy." And I wrote back, "Did you buy anything?" You know, it's your mindset, right? So he's scared. He's there because he hasn't seen this, and he's invested in the market now, and he hasn't felt it. And seeing numbers like that, it's like, oh my God, what's happening? But he said no, he hadn't bought anything.
Well, today we're all at the beach, and we're seeing all these great speakers and this great stuff. And today, I feel like if we were sitting in front of our FactSet machines or whatever, we would have felt like us in particular, who really came into the business in the late 90s. You guys obviously very well documented what you guys did during the financial crisis. Today felt like a very different day than almost every major down day in the markets to me. And that's us like checking our phones like this or whatever. I was on CNBC on Closing Bell just an hour ago, and Sarah Eisen used the expression liquidation, okay, like today's price action. And to me, you know, like I said to her, liquidation implies that you're almost near capitulation, right? Like to me, this feels like it's just getting started. So talk to me a little bit, Vinny, like what's different this time than in mid-June when we went down? It was like 4 consecutive really big down days, and then we bottomed, and then we ripped nearly 20% in the S&P over 2 months.
Well, I think a lot of that is oversold conditions.
Yeah.
Right? So, and we get there, and we're going to get there again, and there will be a bear market rally. Liz, I'm laughing. When you call a bear lazy, you're actually strongly suggesting that you've never been bearish in your life. Yeah. Or actually shorted
That's
a
fair.
stock. Or
That's
actually
fair.
shorted a stock.
No, I have not.
Okay. So that, and if I look at the audience out here and do a show of hands, how many people have ever shorted a stock or have not invested in the stock, or not invested in the stock, I bet the amount of hands, aside from these two guys over here, would be minimal. It's not that many.
Wait, Peter Bookfire's got his hand up?
Yeah.
But Peter Bookfire has both hands
I'm trying to
up.
exclude Peter and Jared
If you
over
put
there,
your
right? Like, so,
if you put your feet up, that means you've also bought puts. Okay.
So the point is that it's very difficult and it's very emotional. We not only have to be right fundamentally, which we feel, then we have to time it correctly.
Yeah.
And then we have to pray to God that no idiot is going to buy a stock just because it sounds good, right?
Yeah.
Whereas no one here is shorting stocks, so it's very, very difficult. I take opposition of the fact that you call a bear lazy. It is the hardest thing on planet Earth, and I don't
She said
anyone
she
do
said
it.
lazy. She said lazy to be bearish, like right now, not shorting stocks.
And that's
like,
my point.
Yeah.
It's
Yeah.
so hard to be bearish and applying a
But bearish
scheme.
could be sitting on your hands and not deploying capital if you have it. Is
That's
that
not
fair?
bearish.
That's not bearish.
That's rational.
Okay.
Right.
That's sometimes you just don't want to play,
Right.
right?
See, I don't view that as bearish.
See, but I find that bearish. So the most bearish I'll ever get is to increase my cash position and not do anything. That's bearish to me. Because as an investor and as somebody who, you have to tell people where to deploy capital, right? The answer is rarely don't have it in equities. If you're trying to build wealth over the long term, and that long term can be even 5 years, you look at a long-term chart of the S&P 500, I think there's maybe 1 or 2 10-year periods where it's flat, but there's never a 12-year period where it's not up, right? So the idea of not having it deployed is bearish to me.
Yeah, again, I look back to near peak valuations historically, right? Price to sales, price to book, whatever you want to look at it. Corporate profit margins are very high, and it's fairly obvious that Powell's taking us into a recession if we're not already in a recession. So my view is that there's not a lot of margin of safety in many of these stocks. I mean, look at Costco. These guys were talking about Costco earlier today. Like, it's a very expensive stock. I just don't see what how are you going to make money?
Well,
in
so
it?
it always has been, right? It's always traded at like 27 times, like literally, and then when it comes
Always
in,
is a long word,
No.
a long time. I mean, like
as long as I've been in the markets for the last 20 years, it's always traded at a massive premium to almost every other
But Dan,
retailer.
the way we think about it, right, is if you're buying something at 27 or 28 times,
Yeah.
your investment thesis is you think that either A, passive investment money is coming in the door,
Yeah.
right? Because it's not like the Costco story is not out there and known.
Yeah.
So you're hoping that another schmuck pays 30 times,
Yeah.
right? That's what you're hoping for is a case for multiple expansion. Okay, that works for the last 12, 13 years. That worked when the Fed had your back and was shoving liquidity down everyone's throat. When liquidity's going the other way, you better be right.
Okay, but let me
At
tell you.
27 times.
So here's a $1 trillion example of investors making the bet that the Fed was going to change course over the last 2 months. Okay, and you know what it was? It was Apple. So it had this re-rating. Everyone's staring at Apple. They're saying it's trading at 27 times in the spring, expected to grow earnings and sales mid-single digits at best. Okay. And then all of a sudden, okay, the stock, which had what, a 30% peak to trough decline, rallies 35%. It nearly makes a new all-time high, right, until like a couple weeks ago. And that's the point. The big names, all of them are going to, they literally, Microsoft had what, 2 turns, like it came in or something like that, 2 or 3, you know what I mean, on that high 20s multiple. So, I mean, Danny, talk to me a little bit about this, because I think this is really important. You just mentioned twice, Porter, peak margins, okay?
Yeah.
Like that's a big part of the valuation of the S&P, and some of these consumer companies have been able to pass on some of these, right? Like some of these like higher costs. This is, to me, this is a huge key to the whole market valuation area.
I want to make 2 comments.
Yeah.
What Liz just talked about. As a mutual fund manager, you can't be in cat. You have to be invested.
Yep.
So you have to pick a sector that you think you can outperform by overweighting or underweighting energy or technology. That's their job. They get paid on their performance relative, not on an absolute basis. Yeah. Hedge funds are obviously very, very different. But the one killer, both in the markets and in corporations, to me, is going to be leverage. And Vinny, we were talking about this earlier. So if you think about large hedge funds that are, or even some of the systematic large hedge funds that are 5 to 6 times leverage, when you go from paying 1% on what you're doing leverage to 3 or 4, just think about that multiplier effect. You are forced literally to unwind. Your risk premium changes. We've seen degrossing in this market is what I've seen. Take it one step further into the corporate markets, right? It doesn't, just because credit spreads are widening doesn't mean that the companies are going to default and not pay. It means their cost to borrow. We've been in this 13-year blissful period as a consumer and as an investor where we never even thought about how 0% car financing, literally 1% mortgage. You didn't think about it as a consumer, and I think we didn't think about it as an investor. And I'm just as guilty, long or short side, to not realize shorting stocks when rates are 0 is not a great recipe. That's not lazy. It's stupid. Shorting stocks at that point.
Yes.
Now my whole point, now I'm fired up. Now my whole point is this. Dan brought up a point before. If you have a broken business model on a stock that gets exposed, and it's literally every day is a new underwriting opportunity, and it's down 50%. We'll take a Carvana that's down. Pick out a name. When you see a broken business model as a short, and you know that the gig is up, that's when you push, right? Because they need debt, they need financing, they need because you know they'll never make money again ever.
During 08 though, like when the banks were careening lower, like there were like 30-50% rallies in some of these things.
Oh yeah,
the business models were exposed.
But Dan, let me just say it all. So there's publicly traded debt on some of these stocks that are trading at 30 cents, 40 cents a dollar. Why would you ever own if you can buy bonds? Why would you ever own the equity of a company at any price where you can get a triple on the debt? Because obviously, if the equity is worth a penny, that debt's going to trade to par. GameStop. Oh, is that a publicly traded security? Anyway, so the point is that Bed Bath & Beyond, pick one of these things. But my point is that that's where people have to kind of, in trying to trade these either meme stocks or things in and out, you will lose money without any doubt if you're not buying a good business model. So I'll turn it back to you.
What do you guys think the financials of today are? So what I mean by that is what took the market down, the center of the crisis in 2008, 2009. Where is that?
Okay, I'll ask you, where have all the flows this year gone towards?
You mean asset class or sector or what?
Sector. Where the flows been to?
Energy,
tech.
Staples.
Tech.
The flows have been to tech.
Flows have been to tech. Everyone has been buying the dip in tech, right? Outflows in energy, value, all this stuff, materials, outflows. Okay. All the flows have been to tech. All these unprofitable companies losing billions of dollars a quarter, where the debt's trading at subpar, and these people are still buying these stocks, which is unimaginable. I mean, it's just the stupidest thing. I don't think people realize that the bankruptcy cycle is going to be real. Like, you're going to have bankruptcies. There's no bankruptcies right now.
Yeah.
Right? There will always be in every cycle bell-ringing bankruptcies, Enron, WorldCom, all this stuff. And and then once the bankruptcies come out, the fraud comes out. You'll see this. It's just a natural cycle. We're big believers in cycles.
I just
right?
had a vision, and I don't know why it came to my head,
I'm scared. Right
of
now.
Guy Adami in Sicily. Maybe wearing a nice gold chain,
Yeah.
like hanging out with a little pizza, limoncello. And the reason why I brought it up was you asked the question, like, where's the bubble now, or what's the issue now? I think the issue is sovereign debt. That's the problem, right? And like, that's my big problem all the time is the constant that we have is that we run fiscal deficits as far as the eye can see. Someone needs to buy that. Somebody. It's like, so for the past 13 years, it's either been the Federal Reserve or the Chinese Central Bank. Now both of them are not buying it. Yeah. Someone's got to buy it. And therefore, we also have inflation. Now, I don't think we're going to stay at 8.3%, but let's say we go down to 3%, 3.5%. Are you really going to go out and buy a 10-year Treasury below that when inflation's
Below
running hotter?
3.5%?
I don't think so.
Right.
Why would you? I would ask anyone out.
We wouldn't. I don't know that I think if it stays in the situation where we're still the best economy on a bad planet, admittedly, but the best economy, then foreign money comes in, institutional money stays in.
Well, first of all, the Japanese are selling. They got to defend their currency, right? They're selling U.S. Treasuries at the moment, right? Yeah. And you think about the global context of this stuff, and things are still pretty decent in the United States. But imagine if you're in Japan and the yen's gone from 100 to 145, and you got to buy oil in dollars.
Yeah.
I mean, it's a disaster. Same thing in Europe, and
they still have to issue debt.
The
That's
British
just
pound.
more coming.
Yeah.
Like, it's not like they're running fiscal surplus.
And everybody's running massive deficits. It's a real, and no one really talks about it, right? And we're going to have to issue in this country $1 trillion more every year in perpetuity
To service.
Who's going to buy this stuff?
All right. So let's just say none of us have the answer to that because we were all yelling about the same stuff when the Fed's balance
we
sheet
have the
was $4
answer.
trillion.
We know the answer.
What's the answer?
They're going to print.
Yeah.
They're going to have to.
At the end
They're
of the
going
day,
to be. They're going to be
So-
have to print.
So the whole mindset about why equities rallied this summer was a pivot, basically a move towards printing. Danny, you and I have been talking about it on the pod for months and months now. But let's talk about let's try to decode what today's data and what investors did in the stock market, in the bond market, to the U.S. dollar, right, to some commodities, because today was I think a really important day, all right? So let's just think about this. The one piece of this kind of macro puzzle here in the U.S. that has not really changed, and this is one of the reasons why no one answered the question about, the pass-through of higher costs, let's say, to consumers, because we have a consumer that really feels like they're on the brink, right? So you have this negative wealth effect from the stock market. You have housing data that's continuing to come down. We know that the Fed was specifically focused also on the housing market. We have unemployment that in August just ticked up, a teeny bit for the first time, right, off of that pre-pandemic high here. So, Danny, talk to me a little bit about employment. Gundlach said it today. I mean, I missed some of it, but I heard him say, well, if unemployment goes to 4%, given what we know about the savings rate, given what we know about consumer credit, we're kind of in a shaky spot here.
I think it's how do you define a recession? Like the old way, 2 quarters negative GDP. Yeah. Forget that because you still have decent employment, so you have to figure something out. My whole thing, how I measure, is purchasing power of the consumer, which is still going down. I mean, you saw the average hourly earnings are not keeping up with anything. So to me, that's the margin barometer that I look at to see. The job losses that we're going to see being lost now are going to be in the white collar area. It's going to be the higher end. It's
so
you saw,
you saw the banks today?
Yeah, the banks. Goldman's going to lay people off. We were joking 2 weeks ago on the podcast when Goldman said people back to work. You made a comment, I guess they can't play Wordle anymore, and I said, yeah, because the 5-letter word is fired. We said that 2 weeks ago, and here they are going to be potentially. Da-dun-dun. No, but I'm serious. It's not funny. It's not a good thing. Blue collar workers finally having their day in the sun. Yeah. That's bad for Wall Street. Too bad. This is the reversion to the mean that's going to happen here. So that means, to your point, a hit to margin. So you got to accept that hit to margin. And those companies have two choices: pass it on to the consumer or start firing people. Because you don't lower people's salaries. You fire them. That's what happens. And so you're asking me where we're going to get. So to answer your first question, what did today, like, what was my takeaway, or people like, we're back to where we were 5 days ago on the S&P.
Yeah.
It's not like, but it feels worse when it's like this. And the thing to me, Vinny will love it, it just feels logical when you see stuff like this, reset.
Rational.
What is the S&P
Logical.
earnings going to be in 2023? Probably somewhere between $200 and $215. Let's just say that that's the range. Is that the trough? If that was the trough, you could potentially say north of a 15 multiple on that, because that's the worst. The problem is, like I said, it's 13 years of unwind. So,
all right. So 2 weeks ago, Snap, announced 20% job reductions. Okay, then they basically cut guidance and they cut a bunch of, like, I'm just using that as an example. So Porter, does that, and the stock rallied 15% the next day. All right, a little bit different of a market than we're in
but
right
shorting's
now.
easy.
Yeah.
Hi, Liz.
All right. So,
I never said
No,
shorting
I'm sorry.
is
I
easy.
said,
Lazy.
Yeah, I know.
We're lazy.
Sorry.
Don't put words in my mouth.
So
I just wanted to
didn't
wait till
say
you had
shorting
something in
was
your
lazy
ice in your
either.
mouth. Sorry.
I
Oh,
said
you
it's
wimped,
easy to
actually.
make the bear
Sorry,
case.
go ahead, Dan.
No, so
Very easy.
that's coming to a theater near you across corporate America, right? And then we're going to see something where you cut jobs and then you also cut spend. Like you start paying for licenses on software, right? That of people that you don't have. I mean, this is where we're going to see the enterprise spending like kind of slow down a little bit. But thread the needle a little bit, Porter, on this kind of unemployment thing. Are we likely to see a lot more very proactive restructurings, if you will, like we saw in Snap?
I don't know if on this podcast we mentioned it, but we've been talking about how, in the 2000 cycle, eventually these tech companies said, wow, we got to, make it to zero, right? We can't keep losing money in perpetuity.
Yeah.
And, you're seeing that with Snap. It's like, oh, okay, we got to start cutting costs. Coinbase, like they got to cut a lot more costs, right? And there's hundreds of companies out here burning cash in a big way. And then you also have, the stock-based comp, and these stocks are all way down. They're issuing more stock. They're diluting the heck out of you. And so, it's a real problem. And, the credit market, we've been on Twitter or whatever we talked about, we've been short Wayfair stock, right? They're issuing more convertible debt at higher prices now. And they have to get out of this spiral of losing money. I just don't know how they do it. And because, the business ain't turning around right now. And they're losing a lot of money. And if you're going to make a bull case, they at least got to make some money at some point, right? And so this is our issue.
To shift it to the consumer,
Yeah.
right? Because we were talking about that. One of the things we used to do as financial guys, and I track a lot, is consumer credit card debt. And I like to look at it on a year-over-year basis, nominal, right? Not seasonally adjusted, not real. And right now, U.S. credit card growth is around 14 to 16%. There is about a 1 month lag. So think about that. This is the highest cost credit to the consumer. That's their quote-unquote warehouse line. It is growing faster than nominal GDP right now. Where's the growth coming from? It ain't coming from the consumer, I'll tell you that much, right? Now, because we typically do not go from 14% year-over-year growth to 25%. What typically happens is we have a slowdown. And so it gets back to our point is I think we have to have a natural cycle. We're fighting it like mad, right? Like we've been fighting it like mad every single time we get to this place. The Fed comes and saves it. I just think we have to go through something. And that's tough.
The Fed can't save us.
But it's going to be more difficult.
Well, they will if it gets really bad.
Correct.
But just so the consumer credit card thing, I think it's important to dive a little bit deeper into. So, yes, it's grown a lot. When you think about just the cycle, though, if we're going to argue about a cycle, right? Defaults right now on all consumer debt, they put auto loans in there, and credit cards and auto loans are probably the lowest quality. They default the most. It's the thing that people won't pay. You're going to pay for your house before you're going to pay off your credit card, right? So auto loans and consumer loans, put student loans in their mortgages. The default rate right now is like 3%.
Correct.
Okay. Look at just credit cards. The amount of the total balance that moves into 30 days delinquent right now is about 5%.
Right.
Okay, so 5% on any given moment is moving into 30 days delinquent. Still pretty darn low, okay? And now it did just start to tick up. The 30-day delinquent did just start to tick up in all those categories. My point is, and this is rational, not bearish. Logical, rational, not bearish yet. That leads by at least a year, usually. So if you look at what happened in the last crisis, those defaults started to tick up, I think in 2004, 2005. right? And the recession didn't hit for 2 or 3 years after that. So even if there's an increase in those defaults, because that's really the risk, right?
Yes.
Credit card debt is ballooning, but the risk is that people default on it.
Correct.
There's an 80%
So at
correlation between job losses and
Yes.
and defaults.
Yes.
And so, we're not. I mean, Canada last week showed their first ever or in this cycle job losses. I would have to imagine our job losses aren't. They're coming. Maybe it's this year. Maybe it's beginning of next year. But it's coming.
The other thing I would keep in mind with consumer credit is there's a very calendar seasonal aspect to it. So between February and May, you have the best consumer credit you're going to see because of tax rebates and the like. So I like to look at it on a year-over-year basis. And so when you look at it on a year-over-year basis, we're increasing. I agree with you, not crazy yet.
Yeah.
But when I look at the growth, which to me is the leading indicator relative to nominal GDP, I know that I'm not calling for a calamity of any kind, but it's going to get tougher. And my bigger point is that it's more difficult to see the growth that people think that we can, quote unquote, soft land ourselves out of. I don't see it without some form of fiscal response.
So that's a fraction, right? So numerator over, denominator. Denominator's been growing exponentially right now because people are using credit more, so that'll probably be on the come. I want to say the one thing that happened in 2004 and 5 that actually created what happened in The Big Short, the biggest misnomer, banks were coming up with new products and mortgages, 220H, 327s, IOs, ninja loans, all this stuff. That actually, to your point, normal subprime mortgages default within 12 to 18 months. That's when you start to see them. It didn't happen. This time was different. It's never different. So I think it's being, I think you got to go back and look at that. The other thing is that what private or public company a year and a half ago was forecasting LIBOR or credit spreads or access in their models for 2023, 24, and 25 at 4, 5, 6%. It didn't happen, and that has a massive impact, I think. And the other thing is that if you're J.P. Morgan and you're providing financing to Wayfair, someone who has inventory, it just became 3% more expensive to hold that. So you have to raise prices into a slowing economy. I think all that stuff, again, is a lost art in terms of how to look at every company is different, bottom up, and how they're impacted. And I think now it's stock picking time.
All right, so Porter, do you think I find it very interesting if you look at the way home builders have traded all year and the way large financial stocks like banks and stuff, money centers in particular, J.P. Morgan being the worst of the whole group, they've underperformed the S&P dramatically. These two groups literally have believed every hawkish word out of Jay Powell's mouth, right? And it was other parts. It was the inflows into tech that didn't believe it, right? Talk to me a little bit about from your guys' experience at Seawolf and obviously at Front Point, when you see these sectors underperforming the way that they have this year, and they didn't really bounce that hard over the summer, you know what I mean, relative to the S&P. I think they underperformed. What did that tell you?
Listen, I mean, financials, they haven't had inflows in a long time, right? And you can see it, right? And the problem is that the earnings right now are just fine. J.P. Morgan's fine. The capital markets business is slowed a lot, but you look at a core middle market bank like PNC or KeyCorp, the earnings are fine, right? But the problem is that the Fed turned off their buybacks and the capital return, and they made it much tougher for them to return the capital. And so the financial sector is this kind of weird place. That's one of the reasons that we sort of shifted from doing just financials to everything but financials. They're wards of the state, right? And if the Fed doesn't like what they see, they say, okay, J.P. Morgan, you can't buy back stock anymore. And so they're just tough. It's a tough sector.
Liz, you're right. The issue is not in the banking sector. They have enough capital, right?
Yep.
They're healthy. The regulated banking sector. The fringe names, the nouveau names, have been a bit of a concern. But to us, when I look at it, I view it as boring. I don't know if we're going to go through a slowdown. I don't want to own them. But in general, we're not short them either.
No.
Right? Because there's nothing to really fight at. I don't think they're going to have a material earnings issue.
They've done a good job. They've underwritten well.
They have, unless there's a deep recession. Yeah. The larger banks, I think, have a bit of an issue on a velocity transaction perspective, is that has slowed down.
It's the non-banks that Danny kept on talking about, Affirm and Upstart for a long time. The underwriting's been atrocious.
All right, so let me ask you this, because in the years after, with Dodd-Frank and all this stuff, I mean, everybody in Wall Street was just yelling about the regulation. Well, look what happened in early 2020. These banks were not going to go under. You know what I mean? And they're not. They're acting pretty well, and a lot. like, can we all agree that, I mean, the under-regulation in the 2000s or the 90s into the 2000s and maybe the overshoot or what appeared to be an overshoot actually worked? Like, Danny, when you think about it, like we had the biggest black swan the world has ever seen, right, in the pandemic. And our banks were, now granted, the Fed, flooded the zone and fiscal and all that sort of stuff. So we kept us in the game here, but they stood up pretty well.
Yeah, the banks, to their point, there's no major issues. You'll have blow-ups here. They were exposed to some type of commodity. We already saw it happen in nickel. They're going to be exposed to certain hedge funds that they're going to have to write off. They're going to be exposed here and there. Bill Wang, I mean, you see these small things, but there's no, massive systemic risk within the banks, in my opinion. It's more of a valuation thing that's going on here. No one wants to be dragged in front of Congress again, regardless. And they've done a decent job. I think they've been forced to do a decent job. You saw just recently all the international risk weightings that have to be done would prevented these companies from buying back their stock, which is a good thing, right? Because you want them to have capital on the sideline. So I don't think there's an issue. Now, some of the European banks potentially, and these off banks that aren't as closely regulated or have one-off issues, different story. But the U.S. banks, and the last thing I'll say is, I said this many times, every bank is very different. Goldman Sachs is a whole different animal than a Wells Fargo. Bank of America is a different animal than a State Street. Like, everybody has their, and again, this is not about buying the XLF. Thanks State Street for the water earlier. I think you should, go out and so on. But it's about looking at the XLF, at the 10 names that are in there and deciding, you know what, I only like those 2 out of the top 10 because of they benefit from higher rates. They don't have the credit risk. And that's what I mean by in terms of stock picking where we have an opportunity. And that's me being bullish. Trying to pick up the mess of what's going on. Anyway, so there's always buying.
Liz, where do you want to be bullish here? So these guys,
financials.
They just said, all right, so let's talk about value, because you guys just said something that, again.
Truly is like Goldilocks in the 3 bears.
It is.
That's exactly what we got going here. But people might not be aware because we have a NASDAQ that's down 25.5% on the year. It was down obviously more than 30% at its lows in June. And you would say, well, that's not intuitive that there's flows that keep coming in. Well, they do for a lot of the passive reasons. And we know if the NASDAQ 100, 5 or 6 stocks make up nearly 45% of the weight or something like that. So where do you want to be? Let's say we have 2 weeks left in this quarter. I mean, listen, I don't know about you guys, but if I'm a CEO, I'm instructing my CFO and my finance team, if I'm a publicly traded company, all right, don't pull a thing forward, you know what I mean, to make this quarter, okay? And actually, let's just kitchen sink Q4 here, because now it's just so my question is, I think we're going to see some pre-announcements, some big ones in the next couple weeks, and then we're going to see a lot of really bad Q4 guys.
We already have seen a lot of I mean, look at NVIDIA. We're pre-announced 3 times in 3 weeks.
Well, that's
a disaster.
And in the cycle before that, we saw Target pre-announced 2 times. So I think we're going to see that. So understanding that there are tape bombs out there, and it's kind of a treacherous sort of environment right now. Where do you, because again, you want to keep money in the market, where do you want to go?
Yeah. So the way that if I had to make a bear case too, what I would say about the pre-announcements thing is, we've so far been able to trick everybody on that, right? Like the pre-announcements come out and everybody has amnesia a week later, and it's like, oh my gosh, we beat earnings, right? Well, yeah, because they guided down 3 times first, so we beat at a much lower level, and that's probably going to run out. So we'll stop tricking people. So the pre-announcements will bring stocks down and keep them down. But where do you want to be bullish? So short term, and when I say short term, I mean 3 to 6 months. Bullish 2-year treasuries. I think at some point there's going to be news.
So
there's going to be only the twos,
Only the twos.
not the Qs, not the Qs.
You love the Qs.
You do.
Well,
I know it rhymes.
Well,
nicely,
listen. Just real quickly, and I know people listen to the pod. They know this. I mean, to me, again, it comes back to those 5 names that have these fortress balance sheets, amazing management. They have monopolies ultimately, and I think this is a very much what's different this time now. And I think that they will obviously, I think in 5 years they're going to be, I think we talked about this a lot last night, they will still be the 5 largest market cap companies in the world. I'm just telling you, not Tesla.
I disagree.
Okay, I mean,
disagree too.
we'll
history just tells you that.
History, in 20 years, history will tell you that won't be the case.
I said 5 though. I'm just telling you, in 5 years, I think that, you tell me what's going to be.
It's hard to see Apple and Google not being 2 of the large 5.
It might be, but
Porter's going to think it's an energy company.
No, I listen. Could they? The DOJ, can they easily go after these companies? They are. You just said it. They are monopolies.
That we've been saying for 10 years. I'm just saying, so they are monopolies.
First of all, our regulators don't have a lot of teeth of doing stuff these days. So I mean,
no administration will have teeth to do it.
No.
I'm just saying, all right, we can put that. And here's the one that I know that, what, of those top 6 names that has the highest potential to be the next $2 trillion market cap company?
do it.
Tesla.
Get out of here.
Tesla.
No chance.
I'm just telling you. I mean, it was 1.2 trillion just a few months ago.
Yeah.
I mean, it doesn't budge here.
Yep.
Yep. Where were you
Just
looking at?
under for something.
Yeah. I mean, this is a $900 billion market cap company in the throes of.
It is the Enron. It is the Enron of this cycle.
Wow.
Enron got hit late in the cycle. I have no idea why people are hiding in this name, why they take comfort, and everybody owns it. It's fine. It's the guy's a genius. The macro is great. Look, EV tax credits, all bullshit. It's 95% overvalued on any metric you can look at.
Yeah.
There is nothing you can. I'm a fundamental guy, so
an
I'm
auto
going
company.
to wait. I'm going to
So what?
take.
It's an
I'm
auto
gonna-
company.
Yeah,
What
it's nuts to me.
The thing that baffles me about Tesla, what I can't understand,
I don't know why we talk about it so much.
is
It's crazy.
it provides a product that for $15,000 that does not work
Full self-driving.
and kills people
Yeah.
on the road.
Yeah.
And yet our regulators do nothing about it.
Yeah.
I don't get it. Who in the world would pay $15,000 for something that does not work?
How are their operating
I
margins
don't
where
get
they
it.
are? They're running factories in Berlin and Austin, supposedly. How are their margins like this?
So can I ask you guys a
Awesome.
question? So
Yeah.
so this time last year, Nvidia had an $800 billion market cap company, market cap, all right? And now it's $330 billion. Do you think that a year from now, when we are here at Future Proof, we will be talking about Tesla as a $300 billion market cap company?
I do.
Do you?
Yeah.
I think it's a high possibility.
I don't. I think it'll be 100.
Yeah.
So, yeah, it's 100 billion.
Listen, people forget these are cyclical stocks.
Right.
I mean,
I don't
there's-
understand. It has everything negative in it that you can have into.
They
it
sell
has regular-
$120,000 cars. I mean, what are we talking about here?
Right.
This is like, it's a joke.
Yeah, it is.
I didn't get to do my other bullish calls.
What was your
please.
Liz, wait, shocker. Liz
Liz
from
has got some bullish
SoFi has
calls.
a few more bullish calls. Okay.
What do you got?
And then we'll get
All
to
I
the
gave
bearish
was-
hedge fund guys.
All I gave was
We're
the short-term
bullish
one.
too.
The
We like
short-term
No, she
one.
did. She didn't do the long term.
I did short-term twos. Long-term.
Oh, yeah, sorry.
Long-term, I do think financials. Look at the valuations. I know everybody screams about the valuations of energy. Financials is the second cheapest in the index. They can't really fall that much further. And as we've just pointed out, they're actually in pretty good shape. So over the long term, and I'll even call long-term 2 years, 2 to 5 years, because most investors can't wait around for 10 years to be right. So we'll call it 2 to 5 years. This is a great entry point for financials. It might get better. The entry point might get better, right? I also think healthcare.
It will get better.
And I know you're going to argue with me about this because I think last night you said healthcare is like the worst sector ever. And I didn't say
Oh,
that
no,
I
I,
was bullish healthcare.
no, I didn't say anything about
But-
healthcare. I don't know anything about healthcare.
He was
Oh,
upset
okay.
they're raising
Okay.
prices so much, though.
Yeah.
Anyway, I think healthcare is another one. I think the pandemic changed healthcare forever. And the marriage between healthcare and technology continues to speed it up and make it an
So
attractive entry.
Moderna can't get out of its own way right now. I mean, you know what I mean?
Yep.
It's just kind
COVID's
of
over.
interesting. I know. I mean, but I just saw their chairman speak last week at a conference, and he sounded pretty impressive about all the things that they want to use mRNA technology to fix. You know what I mean? And again, if
Run and hide.
what's that? Yeah. Right. Other than that, all right. So wait. So you got healthcare. What else you got?
Communications.
And communications is what like cable stocks?
Like Verizon?
Like T-Mobile.
Right.
Yeah, all right, think of it this
Warner
way.
Brothers, maybe.
When you're looking for
this
growth,
way.
if
House
we
of the
can't,
Dragon.
if we're not on the Q's train, which
Yeah.
it sounds like the rest of the
Yeah.
table isn't, you got to find growth somewhere. If you don't want to find it in tech, you find it in maybe consumer discretionary, but that's pretty overvalued right now. And
Yeah.
given if the consumer isn't the bull case, don't buy consumer discretionary when it's
Well,
overvalued.
the
right?
XLY, 40% of it is basically Amazon and Tesla.
Yeah.
All right, just real quickly on my QQQ. So my point is that those top 5 names make up 45% of
Yeah.
the weight. I think 3 of the 5 years from now, will be bigger market caps than they are right now. Okay, I'm just saying. And then I think all that other shit, all the dozens of stocks that are down 70, 80%, dozens of them will rally 200% over like the next few years, whether you guys like it or not. All right, let's really quickly, because we only have a few more minutes here left. I want to talk about, you guys obviously from a macro perspective are very bearish for a whole host of reasons,
Yep.
okay? How do you change your mind about like getting, just like flipping to your being net long and bullish on, on the global economy reflating, do you know what I'm saying? And going through another period of 10 years where the Fed's got your back. Now the Fed has to turn, but like other than that, what makes you guys more constructive?
Well, I think we talked about this in one of the podcasts, but we have a framework that we're in a global sovereign bubble, debt bubble, right? And for me to get very bullish, I have to get over those hurdles that we're not in that bubble, right? And if the U.S. magically finds a way to balance a budget and finance themselves Same thing with Europe. Same thing with the UK. Same thing with Japan. Same thing with China. I'll get a little bit more bullish. But until that happens, like everyone's like, oh, you got to buy the 10-year. You got to buy bonds. You got to buy bonds. Well, magically, rates are now higher. They're approaching 3.5%. Something that was unthinkable just a couple months ago. And, until you tell me that, this is the level where bonds stabilize, I can't really think about going heavily in on the long side, right? And that's what scares me the most. We talked about being scared or being bearish. Like the sovereign debt bubble scares me.
Wait, but are you scared from an economic? You think that there's an economic disaster kind of looming? Is that part of it? Because
we'll print our way out. We're like that's the only way.
Right, but isn't that good for things like equities? Isn't it good for think about it, every time we print our way out.
It's good. It's good for equities, but it doesn't mean it happens at S&P 4000.
No.
Right.
Right. So you can't have it both ways.
Wait, did you just have an exasperated, a really exasperated?
Go ahead.
No,
No.
You can't have it both. Like you got to have the plunge before you get the print.
Yeah.
Right. And so, to me, you're just going to have to go through the cycle. Now, what it would take for me to get really bullish would be a massive philosophical adjustment and change of how we're investing capital in the world. So for the past 10 years, we dump money in stupid things like crypto, Bitcoin. We're about to do it in the metaverse, right? And all that stuff. We need real tangible stuff. We don't need stuff that we don't need.
Productive debt.
Productive debt that can produce a higher ROI on what we're doing. What the UK said, I think a week ago, the new prime minister, was we're going to start investing in energy in their country, nuclear, fossil fuels, and the like. They did a price cap, but they kind of have to.
Yeah.
So when you start seeing stuff like that, I start getting a little bullish.
Yeah.
And we need to do that widespread.
All right, Demo, on a couple of occasions, and literally these were very well timed on the podcast, where I think one was May and one was maybe late July. It was a little early. May was a little early. And like you said, you're always going to be early on kind of bearish calls. You said I went from being this twice.
It was spring.
I went.
Scared,
It was.
yeah.
It was. I went from being bearish
to scared.
to scared.
Yeah.
Okay. So talk about that in the context of and I know you agree with them from the sovereign debt bubble and everything like that, from how you see the economy and then how that translates into, let's say, equities. We already see bonds yields blowing out. We see the dollar at 20-year highs. We're seeing crazy.
An energy crisis that we still have not fixed.
Correct. So with no visibility on that. So how does this play out for stocks right here? We're still 7-8% above the lows in June. What's the multiple that the S&P should trough at, and where do you think we go? The pre-pandemic high was 3,400 in the S&P.
So let me just say what Vinny said. We have to go through a cycle, a cleansing cycle, so to speak, of what it's like to be in a normal environment where the Fed's not always printing. We're nowhere near that yet. What is the level that the S&P gets to that the Fed realizes that, holy crap, there's a wealth effect that's going to have an impact on consumer spending on top of everything? It's through the lows. So it's probably 3,400 before you even start to have those conversations.
Gunlock. He's got a 3,000 target, and then Minard or whatever from Guggenheim, he
let me just say this.
Down 20% by mid-October.
Let me just say this. In March 2009, we had a strategist in our office at Front Point.
Name names.
Miller Tabak. Who's at PIMCO now?
Was it Bookwire?
No, it wasn't Bookwire.
No.
It was... Yes, Crescenzi. Thank you. Tony Crescenzi. Thank you, Peter.
Oh, my goodness.
Tony Crescenzi was sitting in our office, and we were as bearish. I was guilty as anyone sitting in that room.
Vinny and I tried to buy stocks in March of...
I'm going to give you signs for when it's time to buy. He says, quote, housing starts are at 0. He goes, it can't get worse. This is the inventory of homes that are on the market. This is just population demand over time, the math. And we were all in there, and kind of Steve says, you're wrong. It's just data that's being presented. You're wrong from a sentiment perspective. Yeah. So you realize if you get too bearish or too bullish, you need to be shaken by certain things. And it's moments like that where you should have clarity and be open-minded when you see things like that. Because
this is not the level, though.
So this is not the level. But I talked about builders for a long time. The builders will be one of the best longs. They will be at some point. Again, don't buy. Sorry, State Street. Don't buy the XLB necessarily, but pick the names that don't have a lot of debt, that aren't dependent, right? Those are going to be great values, 0.6 points. I don't know. What?
All right, so we all have 32, other than 3,200 targets to the downside. What do you think leads us there to the downside? What sectors?
What sectors lead us to the downside? Probably tech. I mean, it's got to be these things that don't trade on fundamentals.
It has to be.
It's got to be
Trade on multiple of revenues. That does
Apple.
not exist in this market.
Got to be Apple. Apple. I mean,
Apple.
the biggest.
It'll be
So, all right, so let's
Apple's
Qs.
No stock has ever
the
been
math
bigger
of
than,
it,
than
the
Apple.
size of tech
the math.
has to be.
Tesla.
It has to be tech.
I mean, if Tesla just goes down 70%, no, I'm saying they're 7% of the S&P, right? So that's 5% of the S&P right there, right?
They're not Apple 7%.
Whatever.
Apple,
Fine, whatever. But
What do you? So you guys all think it's mega cap tech that leads to the downside? It's the only group that really can because of the size.
That's where everyone's in.
Yeah.
Everyone on planet Earth owns Apple. There's not a soul here that doesn't own Apple.
oh, I want to say one other thing. 'Cause
Directly or indirectly.
Yeah.
what might happen that you're not thinking about? What's the kind of it? And you're going to have more archegoses, not necessarily a family office that was representing more money than they had. You're going to have these. If the market starts to move like that, and we're right on the ocean, and when the tide goes out, and you're looking what's sitting on the floor, it's going to be ugly. You will have moments where you're like, why is the market down so much? People are going to get quote carried out. That's what they say.
Well, let's
You're
talk
gonna see a lot
about this
of
too.
those.
How about the Feds basically said they're going to go until something breaks. I'm shocked nothing's broken yet, right?
I think it might be we just haven't seen that it's broken. I mean, it looks
All right,
nice.
we got 2 minutes left. Vinny, is there a point at the S&P down on the year in 2022 where the Fed at least has to jawbone? You know what I mean? They
course.
have to.
Of
so
course.
what? And how much down is that?
I think it's like 3,400, but there's nothing scientific about that.
Yeah.
I mean, I'll give you another bullish data point
Yeah.
that might be out there that happened
Liz
over
is
the
taking
last
notes.
week and a half.
Yeah.
And I have no edge, a Putin coup.
Yeah,
And I know that-
Putin coup. You heard it here
And,
first.
and that's
Yeah.
I don't know.
Is
can't
that
put a
500
probability.
points in the S&P in
Easily.
2 days like that?
Easily.
Bang.
But a ceasefire, you got to have the gas flowing again,
Yeah.
right? You got to get rid of the energy crisis and put that to bed, which that's not even
That's
close.
near-
Who
term
was your
upside.
bullish thesis?
Well, I mean,
yeah.
well, I mean, let's
Just throwing it out
or a,
there.
a ceasefire. Europe doesn't have nearly as bad of a winter as it relates to their dependence on gas.
By the
China
way,
chills
TTF
out.
natural gas prices in Europe have to come down 70% just
Yeah.
to be actually have Germany produce steel again. I mean, it's
Yeah.
crazy.
All right, Berlin will operate, no problem.
So we had Goldilocks, the Three Bears, and I'm just sweating all over the place here.
Yeah.
All right, Liz, take us out here. Give us something. Give the people something to be a little bit hopeful to. Like bad day. We all agree. I think
Terrible
the
day.
four
I thought it was
of
a
us
pretty good day.
think
Terrible
that.
day.
Well,
Yeah.
for your P&L,
Yeah.
we all think new lows at some point. Probably
Long gold. We forgot to do long gold.
Okay.
Yeah.
Long gold.
Well,
Sorry.
Question is the double bottom in gold? Maybe,
even
hopefully.
even if I were going to get as bearish as I possibly could, I think if we retest lows or we blow through them, it happens in a jiffy. So we had a big day today. I will admit, today was the first day I thought about circuit breakers. I mentioned it to you before
Yeah,
this.
You're getting
pretty
scared.
calm about it.
I thought about it, and I just thought, okay, if we start hitting circuit
Lock
breakers
limit.
on the downside, which by the way is 7% in the S&P, if we start hitting those, it doesn't happen just once. It happens a couple times, but then it just flushes, right? So it goes fast, and that's the thing that you don't want to end up too bearish in that moment because then you're stuck in your bearish thesis and you miss the bounce back up, right?
Well,
The flush
so
is
it
the
could-
bull.
It could,
Is the bull thesis. Long, slow
Right.
water torture ain't good.
But that is the story of March of 2000 to the lows in October of 02, and the story of November 2007 to the lows in March, April of 09. And I think that's a big thing that a lot of investors in this market have forgotten. We lived through those, and they were excruciating. And let me tell you something: 2002 felt a lot worse than 00 in 01, and 09. That late 08, 09 period felt really bad too. So, all right, listen. I hope we leave you guys all just massively uplifted about your portfolios. We hope that you will, just check out On the Tape Pod, smash that subscribe button, people. Leave us a review. Thank you, Liz Young. Thank you, Vinny. Thank you, Porter, and obviously Demo.
It was great to do these in person,
Oh,
right?
love it.
It's like, thank
I'd love it.
God
Usually
COVID's
we have a
over.
little
It's
Como suit
great.
and everything like
Yeah,
that
yeah.
next time. All right.
That's
Well,
the
thank
best
you guys
killer.
for all being here. We appreciate it. Thank you.